Welcome to our Financial Literacy Education series, where we look at a range of topics to help you better understand your money, to help you become more engaged with your money, and to help you make better decisions about your money. My name is Corin Jacker. I'm from Priority One Wealth Management Group. In today's episode, we're going to continue our look at wealth creation. And we're going to focus on two of the wealth creation topics. So to recap the 4 topics of wealth creation that we're covering in our series: investing in your own name or saving in your own name, debt reduction, superannuation and gearing. And I'd encourage you to go and have a look at other episodes where we've covered investing and saving in your own name, debt reduction, superannuation and gearing as separate topics. Also, I encourage you to visit the episode on cash flow and budgeting, because for any wealth creation concept, we need to identify surplus income that can be put towards wealth creation. So you need to understand what income's coming in and what expenses is going out, so you can identify surplus money that you don't need that can be put towards wealth creation. In today's episode though, we're going to cover off a combination of superannuation and gearing. So what we're looking at here is the concept of buying a property in superannuation. So under rules now, we can use the power of leverage, so we can borrow money and buy a property in superannuation. Now typically that has been more focused on buying commercial properties. So as an example, if I was running a business and I had a property where I was renting, if that property came up for sale, it could be an attractive strategy for me to buy the property in my self-managed super fund. My business then pays rent to the self-managed super fund, and I'm keeping that cash flow that was going to someone else in my own investment circle. Whereas now it's become more common to also look at just standard residential property investing. So some of the rules around purchasing a property that you need to be considering, and this is a complicated area, so we're just going to cover things today at a fairly high level. This is one area where you're definitely going to need to seek advice from an accountant, probably a solicitor, and probably a financial planner. So first thing to notice is that when we borrow money in a self-managed super fund, it's what's called a limited recourse borrowing arrangement. And what that means is that the bank or the institution lending the money are limited in terms of what they can do to pursue that debt. If I borrow money and buy my home, if I then have to default on the loan and they sell the home and there's money left over that they don't have and they need to recoup that, they can pursue me personally to repay the remainder of that debt. In a limited recourse borrowing arrangement, the banks are only allowed to have the asset as security, and if there's a shortfall there, they carry that loss going forward. So there's a higher risk to the lenders in lending money to a self-managed super fund than there is typically lending to individuals to buy property. And for that reason, the asset is often held in a trust. So it's a separate bare trust that's established that keeps the asset separate until the loan's paid out. The self-managed super fund has a beneficial interest in that asset, but they're not the legal owner of that until the loan's paid out. So typically a structure might look for something like this, where the self-managed super fund will have a corporate trustee. There are many advantages and disadvantages of corporate trustees versus individual trustees, which we won't go into today. But typically they'll require a corporate trustee when you're looking at limited recourse borrowing arrangements. They establish a separate bare trust for the property. The property is then purchased using cash deposits from the self-managed super fund. The fund borrows the balance to pay out the property. And then typically what happens then is you've got the self-managed super fund, which it's receiving now contributions not only from your employer or your salary sacrifice or your personal contributions, but they're also receiving rent as well from the property, so that investment income. It will then pay the expenses of keeping the property upkeep though, which includes interest on the loan. So the self-managed super fund would be repaying interest and potentially the principal on the loan as well. And that way they'd be accumulating that equity, and eventually when the loan's paid out, the self-managed super fund then owns that property, receives the rent just like any other investment, and that can form part of the self-managed super fund portfolio. We looked at a case study though, and the main things to probably consider in the assumptions we've used in this case study is that a self-managed super fund would typically have higher expenses in terms of buying a property than an individual would. For those reasons I touched on before, where the banks typically, with that limited recourse borrowing arrangement, they'll require a higher level of deposit. The interest may well be higher than what you might pay if you personally borrowed against your own home. And there could be an increased level of cost to set up the self-managed super fund if it's not already set up, to set up the bare trust that's required for the property to be held. So there's usually a number of other additional costs that add an additional layer to a self-managed super fund strategy doing this compared to individuals doing this. So that's one thing to keep in mind before you embark on this strategy. This is what it typically looked like when we use those assumptions and analyse what can happen over a period of time. And this is if the property is realised at different times, so if it's cashed in and sold. In the short term, the personally held investment option is usually a better option than a self-managed super fund. And the reason for that is one, the higher initial cost of the self-managed super fund will absorb, and potentially the higher ongoing cost. But typically, the super fund claims a tax deduction on the interest on the loan, but its rate is usually a maximum of 15%, whereas an individual taking out a gearing strategy might have tax rates of 30% or 40%. So they're getting a bigger tax deduction in those initial years. So typically, an individual might be financially better off having the investment in their own name in those initial years compared to the self-managed super fund. But as you can see in this example, the further we go on, the more attractive the self-managed super fund becomes. And the main reason there is around capital gains tax. If we hold this property to retirement income stream phase, now in our other episode of superannuation, we covered off superannuation tax rates, and it's typically tax-free in retirement. And that reason we can sell a property in retirement phase and pay no capital gains tax, whereas an individual, I still might have to pay capital gains tax. So a self-managed super fund property investment can be attractive if held for the long term and if taking advantage of those concessional tax rates of superannuation in retirement. But it's still not huge, so there's still a good argument to buying property in your own name. Particularly, you've got to take into account a number of other rules that come into play in relation to the restrictions on who can use the property, how you use that property, how you develop that property, and how you run that property. So there could be a number of reasons why buying a property in your own name can still be a much better option than a self-managed super fund. But it is an option, and I particularly find it appealing for, as I said before, business owners buying their own property that they're using as a business premises can be particularly attractive, but it doesn't come without its pros and cons. So make sure you get a good advice on this one. Make sure you look at our other episodes on wealth creation. Thank you and goodbye.